Here's the economic update for February 8th, 2026. So on February 5th, in terms of jobs, we had a report that came out for the Challenger Gray Christmas report. It's the highest January jobs cut since 2009. They had a bit over 241,000 jobs lost. The U.S. cut 108,435 jobs in January of 2026. Do note that October 2025, we also had very high job cuts of over 153,000 jobs. We've also seen this is the lowest January hiring on record. This is all the way back to 2009 as well. There's only 5,306 businesses that are planning to hire. On February 8th, the ADP report came out. We added 22,000 jobs in January. I'm waiting on the BLS numbers, but they were supposed to come out on Friday, but because of the US shutdown, it delayed those. ADP numbers for December jobs was plus 41,000. If you go by BLS, we had plus 50,000, so they're not actually that far off, and that's both for December. The BLS got revised down for November, so now it's only plus 54,000 jobs. BLS also got revised down significantly for October, so we lost 173,000 jobs. So even if you add the 54, the 50, and say the 22, you're still at a net loss over the last 4 months for jobs. Challenger Gray Christmas also came out, and they said that 2025 had the highest layoffs in a number of years. It had 1.2 million layoffs, and the only other years that we were higher were 2001, 2002, 2003, 2008, 9, 2020. What did all these have in common? Well, 2001, 2003 was the fallout of the dot-com bubble. 2008, 2009 was the Great Recession. And 2020, we were in a pandemic. So you don't really want to be compared to any of those time periods. Layoffs that came through in January included Amazon for an additional 16,000 employees that have been laid off. This is a total of 30,000 over the last about 12 months. UPS is laying off an additional 30,000 employees. That's on top of the 48,000 they laid off last year. So that's a total of 78,000 jobs that they're cutting. Dow Chemical is cutting 4,500 jobs as well. Nike another 775, Home Depot 800, and it goes on and on to add up to that 108,000. On February 5th, we had the JOLTS report. There are 6.5 million jobs open. This is not a good sign because this is dropping pretty quickly. It dropped by 966,000 jobs compared to what was open a year ago. On January 9th, this is the last jobs data that we had. This is still delayed due to the shutdown. There's 7.5 million people that are unemployed. Our unemployment rate was 4.4%. You have 7.5 million people that are out of work, and there's 6.5 million jobs available. Effectively, even if everybody found a job for the open jobs, there'd still be 1 million people looking for a job with no jobs available. So it's over 1.1 unemployed people per job at this point in time. Right now, I'm watching what they call the SAM roll. This is effectively if you have an average of 3 months this year compared to the lowest 3 months average last year, and that goes above 0.5, that tends to mean that you're already in a recession. How's our inflation doing? Well, on January 13, we got our consumer price index of 2.7% and our consumer price index core, that's minus food and energy, 2.6%. This is unchanged from the month before. January 30th, we got our producer's price index of 3% and the core minus food and energy, 3.5%. Do note that if the producer price index starts to go up quickly, they're going to pass on the cost of what they're seeing in their goods to the consumer. So then you would expect the CPI and the PCE to eventually follow whatever the PPI is doing. January 22nd, we had our personal consumption expenditures at 2.8%, and our personal consumption expenditures minus food and energy core have also 2.8%. These have been just kind of like staying pretty stable. They've gone up slightly, but if you look over the long run, they haven't moved too much. Do note that all of these are above the Fed target of 2%. Do note that the Fed has dual mandate. So one part of that is keep inflation low, so keep stable prices. So they target about 2%. We're above that. The other one is to keep maximum employment. We're not doing a great job at that at the moment because unemployment's been increasing over the last 3 years. We were at 3.5% about 3 years ago, and it's climbed to 4.4%. 4.4% is not a crazy high number. It's still historically low in comparison if you look back, over decades. So it's not that worrying at the moment, but the concern is we're seeing less and less jobs, and we're seeing an increase in layoffs. So the fear is that could grow pretty rapidly. So in terms of monetary policy, on January 28th, the Fed had a Federal Open Market Committee meeting, and they decided to hold interest rates at 3.5 to 3.75%. This is the Fed rate. This is the overnight rate. This is like if you go put money into a bank account. This is what your bank is usually trading that money for, making it about that percent. So they usually give you a little less than that, at least for high yield savings. Do note that quantitative tightening ended December 1st of 2025, and basically RMP started on December 25. This is not exactly quantitative easing. They're not at that point yet. This is noted for liquidity's sake. I am taking a look at the balance sheet for the Fed, so this should no longer go down. If this starts to increase dramatically, I would consider that QE. And then if you look at the 10-year minus the 2-year yield on US Treasuries, you'll note that is starting to steepen above the 0.5 threshold. So generally what happens is if you see the interest rate go below zero for the difference between the 10 and the 2, and then accelerate above 0.5, that's usually when the recessions start. Now, if you look at GDP, we're not in a recession currently. In terms of the consumer, on February 6th, we got the Michigan surveys of consumers. So the index of consumer sentiment, it's actually positive month over month. So it's actually going up for once. And year over year, we're still down over 11%. The current economic conditions, we actually went up 5.2%. So that's good month over month. But however, we're still down 11.3% year over year. The index of consumer expectations, we're down month over month 0.7%, and year over year, we're down 11.6%. A little bit of a bright spot, manufacturing on February 2nd, ISM report came out. Manufacturing is growing for the first time in over 12 months. Manufacturing has really been suffering since 2022. They did note that manufacturing PMI, new orders, production, new export orders, and prices are growing. All of these are good except for prices, because if prices are growing, you're going to start seeing that in the PPI, and then that's going to come down to the consumer when you buy things. They did note that employment is still contracting. They're still laying people off, so that's not good for the employees. However, there was a note in another report that year over year, the US has increased its productivity by 4.9%. So that might make up some of the difference and allowing them to have less workers, but still be able to increase their production. Our leading economic indicators on January 23rd, the leading economic indicators have declined again in October and November. They're basically noting that consumer expectations and new orders were not doing so well. And this is looking back at October and November. But remember, our February data, which is from January, we're starting to say for the first time new orders are now growing. So if new orders are now growing, that might help to get rid of this LEI negative drag on here. Now, for the coincident economic indicators, this still grew in November. It was down in September and such. This is starting to, in my opinion, it's kind of leveling out, and that's not a good sign because you're either growing, or if you're leveling out, it's not that far away from going down. So hopefully that stays up, but if it did make a turn, it wouldn't surprise me. Do note that the LEI was not negative enough to have a recession signal. So that's a good sign, but they are saying that it's likely to have a slowdown in 2026. How's the gross domestic product, or GDP? In first quarter of 2025, it was negative 0.5%. Second quarter of 2025, it was plus 3.8%. That's really strong growth. Third quarter is the highest it's been in over 2 years, positive 4.4%. And our estimate for fourth quarter of 2025 is currently at 4.2%. These are very high growth rates. So those are really good in terms of, businesses. However, I see the people are suffering at the moment in terms of if somebody's looking for a job, it's getting more and more difficult. What am I doing with all of this information? First off, if we ever did hit a recession, which tends to happen on average about once every 6 years, they last about 10, 11 months on average, and the unemployment rate tends not to go above about 10%, meaning about 90% of people continue to have employment of some sort. 26% of people that are on unemployment have been unemployed for more than 6 months. So with that, please get an emergencies fund together. $100 is better than $0. $1,000 is better than $100. What you want is about 6-month emergency fund. Reason being is if you are unemployed for 6 months, you want that cushion to give you some time to find another job. Now, that money I would typically put into a high yield savings or CDs, something that is FDIC. I don't invest that money. Any money that I need sometime in the next 5 years, say I'm buying a car, a house, there's a wedding, something along those lines, or I'm retiring in less than 5 years, I'm going to put that in high yield savings. I'm going to put that in CDs because it's FDIC. It has some level of insurance up to $250,000 there. For money I don't need for at least 5 years, that's what I'm putting into the stock market and other assets. What I do is I use dollar cost averaging. Every time I get paid, I buy the same amount of money into those assets. About 70-80% goes into the S&P 500. About 10 to 20% goes into the total international fund. Then about 0 to 10%, I'm starting to buy a bit more bonds, so I'm closer to that 10% at the moment, goes into bonds. And why bonds? Because people are like, oh, the interest is going down. Why would you buy bonds? Well, the reason why I'm buying bonds is effectively as interest rates drop, bond value goes up. There's an inverse relationship between the two. And I don't mean US savings bonds that I have pieces of paper or like short-term 0 to 3 month bonds or something like that. What I'm talking about are longer term bonds, so that as interest rates go down, the bond value of that goes up on the open market, and then I can sell off the bond as interest rates collapse. So that's where I'm going with that. That's only going to really come into play if the Fed starts quantitative easing, which happens most likely during a recession. So if we have a slowdown and they try to prop up the economy, they drop interest rates, they start buying up long-term bonds. If they're trying to drive down interest rates on 30-year mortgages, they could also do something similar, because if they buy up a bunch of 10-plus year bonds, that helps drive down the interest rate on mortgages as well, because they're closely tied. I also gave you an update on silver and gold before, and I did warn people that I have seen silver and gold in the past shoot up very quickly, and then quickly following, they went down by 80% or so. So it's no surprise at the moment to see silver go up to $116 a share, and now it's resting below $80 a share. For me, I'm still holding silver, I'm still holding gold, copper, and all these metals, but I'm not buying anything, and I haven't bought anything since they were below $20 an ounce. For silver, less than $1,400 an ounce. For gold, about $1 for copper. So I've held on to them for a long time. I would consider buying silver if it dropped below $30 an ounce. That's where my price point is, but I don't know if it'll get there anytime soon. Thank you for watching. I hope you enjoyed the video. If you enjoy this type of content, consider subscribing. I cover a lot of topics such as how to make more money, how to save money, especially on taxes, how to start businesses, and how to invest. So if you're interested in those topics, please subscribe. Thank you for watching, and have a great day.